everybody. This is Eddie Ghabour. I am the CEO and co-founder of Key Advisors Wealth Management. Please subscribe to our YouTube channel for up-to-date videos, as well as timely videos when we're making any major changes and trying to educate investors. So I just shot a quick interview with Fox Business. Obviously, it was a live interview. It was cut short because there was a lot of other things they needed to get to today. But we talked about the subject of why I believe buy and hold does not work in this environment. And I actually started talking about this in December of 2021. And at the time, that was probably a pretty controversial thing because everyone in our industry always says, stay diversified, it will come back. And there are times when I firmly believe that that is the right investment strategy to have for clients, just like the bull market of 2021. We were fully invested most of the year, and we did not start selling out of our higher beta plays until the end of 2021 and going into the beginning of 2022. It's been well documented that we got very bearish early on, and we were very fortunate and blessed that the timing was very, very good for our clients. And so now on today's interview, I talked about why buy and hold still isn't working in this environment, in our opinion, is because we still believe that we are in a bear market. And I know there's a lot of folks out there, every time we have a bear market rally, they come out and say the bear market is over. I even heard people in the summer saying we're going to go overweight small caps and we're going to buy regional banks. Look, in this environment, those two sectors have not been in our portfolio. And unless we're going to do it for a quick trade, it's not going to be in there until we're through this bear market. So let me explain why I think we're continuing to be in a bear market. And it's really very simple. And I will debate anyone on this in the country. I say that respectfully. There are folks that think this economic cycle is now over and we are heading back to a growth mode. I couldn't disagree more. You have to have your head buried in the sand if you can't see what's happening under the hood. It wasn't that long ago where we had major banks fail due to how high interest rates went, and the treasuries on their balance sheet lost a lot of value. Treasuries are higher now than where they were in March. So those losses are worse now than where they were in March. And to think that we're not going to have more bank failures in the regional bank space, to me, again, this is my opinion, is naive. And maybe they don't fail. Maybe the government comes in and saves them. But there will be, in our opinion, and I have a very strong conviction on this, more consolidation in that space. I mean, just look at the regional bank ETF. It's down over 30+% this year. These equity prices are plummeting in that space. And it's because of the fact when you look at these regional smaller banks, they're in trouble. Their business model's in trouble. You've got an inverted yield curve. You have credit tightening. People are borrowing less money. And by the way, they have a lot of commercial debt on their balance sheet. Commercial real estate, this has been well documented. We've talked about this for a year. It's probably one of the worst sectors right now because of high interest rates. Let me rephrase that, higher interest rates. These rates are not high. They're normalized. But when you're coming from zero and now you're looking at 5-6% yields, people think it's high. Next is housing, right? Residential housing has held up extremely well. But now as we look forward over the next 6 to 12 months, and you talk to realtors in your area and ask them how the activity is going for them. When mortgage rates are up to 7+%, who's going to sell their house if their mortgage is at 3 or 4% to buy something and finance it at 7% or 8%? The only way they will do that is if the house they're buying's price comes down far enough that the payment's the same. So you're going to have some fundamental issues in residential real estate next year on top of the commercial real estate. And residential real estate touches a big part of our economy. We have been saying this repeatedly. People have debated it with us, but it is crystal clear now and should be crystal clear to everyone. These high interest rates are not going down until we have a recession. And as long as our government continues to spend money at the pace that they're spending it, that is counterintuitive to what the Fed's trying to do. The Fed's trying to slow things down, and our government is spending more money And what that's doing is causing inflation to reaccelerate. We're at a pretty dangerous spot from an inflationary standpoint because the Fed's worst nightmare is an increase in inflation, where you start to see it reaccelerate. Look at oil and gas prices. Okay? There's a real chance that the Fed has to continue to raise rates to combat the spending that our government is continuing to do at a reckless pace. So small businesses are declaring bankruptcy at a pace that is on the level of 08, 09. You have regional banks down 30+%. You have long-term treasury ETFs that have lost 40%. Some of them have lost 40% of their value in the last 20 months. How are any of these things a sign that we are accelerating from a growth standpoint in the economy? And then last, and maybe the most controversial debate, is this whole narrative that the consumer is strong. Folks, get in touch with the real world. I talk to families around the country every single day. And you talk to these hardworking Americans, and they are finding it very hard to make ends meet. That is not a narrative to scare anyone. That is a reality. We have credit card debt that's over $1 trillion. If the consumer is so strong, why are they having to put a lot of debt on their credit cards? And here's the biggest problem with this debt bubble that we have. And it's at the government level, and it's at the consumer level, and it's at the business level. We have the highest amount of debt we've ever had in the history of this country when you put all those numbers together. And that debt is used to being financed at very low interest rates. Well, now some of the interest rates on this debt is 2 and 3 times. Folks, this is just simple math. It's mathematically impossible over the next 6 to 12 months, if things stay just as they are now, that there's going to be the same amount of disposable income on the consumer side and the same amount of profit on the business side when expenses are going up like this. And it's not just a credit card debt. Think about all the families in this country that use a line of credit on their house to buy a car, to do home improvements. Those lines of credit, the interest rate on those things have gone anywhere from 3 to 4% to 8 to 9%. Think about that. The carrying cost of this debt and the cost of capital is the biggest problem we have right now, which is why we have not seen the bottom of this economy. Now, yes, the government spending is probably going to make the GDP number look so good when we get that number in October. And I expect it to be good. And I expect the narrative to change in October, and people are going to say, oh, look, there's no way we're going to have a recession now. And what will probably happen is more money will pile into the market, cause the market to have one last rally that could last to the beginning of the first quarter of next year. And then I think reality is going to set in. I don't think it is possible for businesses and consumers to continue on in a positive manner if rates stay at these levels. The next 6 to 12 months, I think, is going to be very, very challenging because of that. And look, I want to stress this too, and I know people are going to lose jobs, more businesses are going to go out of business, but these current interest rates are where they should be. Investors and retirees should get paid 5-6% for saving money. This whole zero interest rate policy should never happen again. This is the reason why we're in this mess. So you can't have your cake and eat it too. Zero interest rate policy causes asset prices to go through the roof. That means higher interest rate policy will cause those asset bubbles to burst. And if you have money on the sidelines that's not at risk and that bubble bursts, you're going to have an opportunity, in my opinion, to make a lot of money. So let me take a quick step back here and just talk about strategically what we plan to do over the next 6 to 9 months. We probably will. We just started buying some energy. I think energy works in a recession as well too. Although if you get a VIX 25 to 30, nothing's going to work. I may be a little sarcastic there, but it's going to be very challenging for any equity to work. But fundamentally, we really like oil right now. You can get some good yields in that space as well too. And that's the biggest thing right now, especially if you're retired or close to retiring. These high interest rates are a positive because you now will be able to take your money and invest in things that are yielding potentially a yield higher than what you need to maintain your standard of living. And that's what we're slowly going to do. Even the equities that we're looking to buy, we're seeing some prices that have plummeted so much that the dividend yield is very attractive. So we're going to continue to buy things that we think will rally in the fourth quarter if we get that rally. But our buffer is going to be the dividend yield. I believe we'll be able to build a portfolio and have portfolio construction for our clients that we build out over the next 6 to 9 months that will generate a cash flow for them that will not only meet but exceed their income needs. And then the appreciation we'll get on that underlying asset over the long haul, if we get appreciation, will be gravy. That's a way to hedge in this environment, but more importantly, that's how you take advantage. Remember, there's always winners and losers in every environment. The losers right now are anyone that needs to borrow money or refinance or buy a new home. Those are the losers. The winners in this environment are those that have saved money and done things the right way, where they can now take advantage of this higher interest rate market environment and build a portfolio that could be a cash flow machine. That is our goal for our clients. You have to determine if that's right for you and your family, because nothing I'm saying here is a recommendation for you. This is just me being very transparent on how we're seeing the world and how we plan to take advantage of this current environment. So we're very excited for our clients because it's been a very long time since we've been able to talk to them about increasing yield substantially on their portfolio and potentially even taking lower risk and getting the same expected return they were looking for. So zero interest rate policy needs to never come back again, and us recalibrating to this new interest rate market environment is going to be very painful for many, unfortunately, but is necessary pain for us to get to where we need to get to in this country. We have borrowed too much money, and now it's financed at levels that is unsustainable, that's going to cause things to really struggle, in our opinion. So that's it for today. I hope you found this to be educational. I hope you and your family make it a winning week. And remember, nothing I said here is a recommendation for you and your family. You have to determine what's best for you based on the data that you evaluate. Thank you. Have a great day.